When the pandemic began and stocks plunged, most people likely expected that the housing market was next in line. But with the Fed lowering interest rates and printing loads of money, we've seen the exact opposite unfold. The median sale price of a house in the US has skyrocketed from $322,000 to $428,000 within a matter of 2 years. This translates to an annual growth rate of 13.2%, which is literally higher than the S&P 500. This is of course unsustainable, and it has caused many to speculate that a housing crash like we've never seen is just around the corner. You just have to make one search on YouTube to see how prevalent this theory really is, and its popularity isn't that surprising. The Fed is finally starting to raise interest rates, and the housing market is finally starting to show the first signs of a potential slowdown. There aren't as many bids on each property, and inventory is slowly starting to build up. Not to mention, the stock market is teetering on bear market territory, so it only makes sense that this pain extends to real estate, right? Well, yes and no. While it is likely that we see a cool down in real estate of 10 to 15% across the board, and maybe 20 to 25% in some more heated areas, it's not likely that we see a 2008 style 40 to 50% collapse with loads of foreclosures. And here's why. Starting off, the first thing to understand is that a recession and the stock market crash are not indicative of a housing market crash. In fact, there's plenty of recessions during which housing continued to go up even during the recession, and this is especially true during periods of high inflation. Likely the best comparison that we have to today's market environment is the 1970s, when there was also sky-high inflation. We saw inflation peak above 10% on multiple occasions, and it wasn't until interest rates were raised to over 10% that we finally saw inflation cool down. There were multiple recessions during this time period that lasted for multiple quarters each. For example, let's take a look at the recession that took place between 1974 and 1975. During this time period, the S&P 500 got obliterated, dropping a full 50%. But what do you think happened to housing? Given this massive sell-off in the stock market, you would at least expect a cool down in real estate, right? Well, the median sale price actually increased from $34,000 to $39,000. In other words, housing grew by 14.7% while the country experienced a recession and the S&P 500 dropped by 50%. And this isn't a one-off thing either. This happened on multiple occasions during this time period. For instance, we saw another recession during the first half of 1980. This recession was accompanied by a 20% sell-off in the stock market, but housing prices still went up. Similarly, in the 1981 to 1982 recession, the stock market sold off 25%. This time, the housing market actually had a slight pullback, coming in at 5.7%. But nonetheless, housing prices were still higher at the end of the recession than at the beginning of the recession. As you can see, just because there's a recession and the stock market crashes does not mean that the housing market must crash as well. Something else to note is that a lot of people think that the rate of increase in housing prices are indicative of a housing crash, but this is not really true either. Throughout the entire decade of the 1970s, we saw abnormally high growth in real estate prices. When President Nixon dropped the gold standard in 1971, the median sale price stood at $25,800. 10 years later, the median sale price stood at $69,400. This means that housing prices grew 168% during these 10 years. That translates to an annual return of 10.4% for an entire decade. While that might be hard to believe at first glance, it makes perfect sense when you account for inflation. The average inflation rate during these 10 years was a whopping 8.42%. So really, real estate only grew about 2% per year during this time period, which is very sustainable. The thing to keep in mind is that real estate is one of the most trusted and reliable safe havens to protect against inflation. So it only makes sense that real estate would at the very least keep pace with inflation, regardless of whether there's a recession or a stock market crash. So don't think that housing prices have to come down just because they've gone up so fast. As long as inflation is high, that scenario remains unlikely. Another popular argument for a housing market crash is rising interest rates. People argue that as interest rates go up, people will be able to afford less, meaning that sellers will have to decrease prices. While this argument makes sense during normal periods, the thing to consider is that supply is extraordinarily low. Housing inventory is literally at 40-year lows, and the trend has only been downwards. So it's not clear how much rising interest rates will even affect housing prices. For example, let's say that 30-year mortgage rates go all the way to 8% from their lows of about 3%. The general rule is that for every 1% increase in mortgage rates, purchasing power decreases by roughly 10%. So, a 5% increase in mortgage rates would decrease purchasing power by 50%. Now, that's quite a decrease, but even if this results in inventory doubling, we'll only be back to pre-pandemic levels. In other words, the decrease in purchasing power would more or less just wipe out the excess demand. So, while houses may no longer be selling for crazy amounts above listing, I'm not sure this would drag down the listing prices themselves all that much. Something else to note is that even with these massive hikes, interest rates are still super low on a historical basis. And even more importantly, real mortgage rates are still negative. While a 6% mortgage rate may sound high compared to 12 months ago, 6% is still lower than the 8% inflation that we've been seeing. So, from an investment perspective, taking out a mortgage right now is still rather appealing. And the last thing to consider regarding mortgage rates is that they're completely irrelevant to a significant amount of buyers because they're buying with cash. Now, this isn't to say that they don't keep tabs on mortgage rates, but in terms of purchasing power, it does not affect them whatsoever. I'm sure these guys would like for the real estate market to cool off as well so that they can buy lower. But most of them are not going to wait for a crash because they have excess cash reserves that need protection from inflation. I mean, these 13 companies alone hold $1 trillion in cash. Now, Apple is likely not going to go out and pick up single-family homes, but banks and financial institutions will, and that's exactly what they've been doing. In Q4 of 2021, for example, almost 20% of all US home sales were to institutional investors who were more than likely paying cash. So, rising mortgage rates probably won't cause a housing market collapse, and if you don't believe me, just take a look at the 1980s. After a decade of high inflation in the 1970s, the Fed decided to jack up interest rates to unprecedented amounts. This caused 30-year mortgage rates to nearly reach 20%. Given that mortgage rates were at 8.5% just a few years before this means that mortgage rates rose 10%. According to a rule of thumb, purchasing power should have decreased by 100%, and housing prices should have gotten flamed. But in reality, real estate prices actually ended up rallying 100% over the next decade. So if an 18% mortgage rate did not cause a crash, there's no guarantee that a 7 to 8% mortgage rate will. Yet another factor that is preventing a housing crash from taking place is that homebuyers are more qualified than ever before. Here's the thing, for 2008 style collapse to take place, there needs to be a fundamental crisis. Secular variations in supply and demand due to mortgage rates and inflation are not going to crash the housing market 40% within 12 months. For that, you need a fundamental crisis like loads of unqualified buyers and low cash reserves across financial institutions. But we're not seeing that. We're actually seeing the exact opposite. The average home buyer is more qualified than ever, and the reason for this is that the average person can no longer afford these homes. So it's primarily just high-income families that are buying homes. In Texas, for example, the median home buyer has a household income of $112,000. This puts the average home buyer in Texas in the 71st percentile in terms of household income. In other words, the majority of homes are being sold to people who are well off. So it's quite unlikely that we're gonna see a crisis where people suddenly can't pay their mortgages. Now, you might be saying that these people may lose their jobs during a recession, which could change their financial position. But the truth is, the vast majority of job losses are usually amongst everyday blue-collar workers. White-collar workers are generally some of the last people to lose their jobs because of two reasons. One, these employees are harder to replace, so companies are more reluctant to let them go. And two, most of these guys work at cash-rich IT companies that can afford to weather a recession. Also, even if the company cannot survive the recession, it's more than likely that the home buyer can survive it themselves. The median bank account balance rises exponentially with income. For example, the median bank account balance in the US is only $5,300. However, the median bank account balance of someone earning between $90,000 and $100,000 is $70,000. The median home buyer in Texas actually makes even more than this, so it's likely that they have nearly $100,000 in savings. The median monthly payment on a new mortgage was $1,931 in February. Even if we say that's $2,500, these median homebuyers could keep up their mortgage payments for 2 full years before running into problems. Also, it's not just homebuyers who are on top of their finances. Banks are on top of their finances as well. JP Morgan Chase, for example, is holding $1.5 trillion in cash, and Bank of America has $895 billion in cash. These institutions and homebuyers are more liquid than ever before, meaning that the odds of a fundamental crisis are also lower than ever before. In the end, there's no question that housing is becoming increasingly unaffordable for the average person. But this does not mean that the housing market is going to collapse anytime soon. It appears that many people are hoping for a massive plummet so that they can finally buy for a reasonable price. But the truth is that 2008 was a one-off thing. I mean, just take a look at the last 60 years worth of pricing data. There are times where the market goes sideways or cools off 10-15%. But 2008 was the only time that the housing market actually crashed. Since then, regulation has tightened significantly and lenders have become extremely cautious. So it's primarily just high-income families and cash buyers who are driving the current market. On top of this, from the 1970s and 80s, we've seen that real estate can continue to skyrocket despite recessions, stock market crashes, and interest rate hikes. Now, this isn't to say that we won't see a cool-off like we've already been seeing. As mortgage rates rise and inventory builds up, the real estate market will no doubt soften. But to correlate that to a full-on housing crash is quite a leap in logic. To be honest, the vast majority of articles and videos that are telling people that there's going to be a monumental housing crash are just preying on these people's desperateness to afford a house. But that's just what I think, and I'm just some random guy on the internet. Do you guys think that there's going to be a housing collapse? Comment that down below. Also, drop a like if you hope that inflation doesn't get much worse. And of course, consider checking out our Discord community to suggest future video ideas and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.